Hello, everybody, and welcome. I'm Bonnie Halper, and this is our online insights because we don't always just simply have investors. We host these every 2 weeks online over Zoom, and we always post them in my newsletter, which is startuponestop.com. I'll post the link in the chat. I am a super connector, and I'm really a super connector. I'm not kidding. I know everybody or somebody who knows them. And I also help founders with their pitch decks. You all need help with your pitch decks, trust me. And then I make introductions to investors where and when appropriate. And I want to thank Joseph Katz for hosting us. Joseph, tell us about you.
Thank you, Bonnie. Good morning, everyone. Thanks for joining. I'm Joseph Katz. I help companies grow using strategic marketing. Most notably was a recent company I helped start up and had a $100 million exit, which was exciting to be part of, and help companies put together the plans to help them grow. So if you need growth marketing, I'm happy to have a conversation. I've spoken to a bunch of you guys on this call, so you know what I do, and happy to continue those conversations. Hope today's exciting for everyone. Joe's amazing, so we'll speak soon.
Yes, he is. And speaking of which, if you don't think a deck doctor is necessary, I just finished the deck for a company just last week who had been trying to raise for 6 months, got nowhere. They hired me to redo their deck, and they just closed on 1.1 million in a week. So it does make a difference. Joe is our guest once again. We love having Joe because he always gives us insights that no one else offers. And it's not just about investing, it's about what's going on out there. So Joe, tell us, do you want to introduce yourself first, or do you want us to go around the room? It's up to you.
Oh, yeah, let's go around the room.
Okay, let me see who's first on my list here. Janice.
Hi, good morning, everyone. Joe and I had the pleasure of speaking yesterday. So I am the founder of Tausi Brands, a patented reinvention of a pillowcase. If you have a head, neck, or back, you want to check out Tausi Brands.
Oh, Darlin, welcome. It's Darl's first time, although we know him from Diffuse.
That's right.
Yes.
Thank you, Bonnie. Yeah, I guess everyone knew here except for Zarin. Zarin has met with me and on her own too. I'm from White City, Saskatchewan in Canada, and I've been busy for a very long time developing concept model for an international digital asset and services exchange. I'm also a task force member of the B20 for Canada and the International Digital Policy Documents. Third round this year in India. First round was in 2017 in Berlin, Germany.
Who's it? David?
Is there one David? Just me, Bonnie?
Yes.
It's David Littauer, Renegade Marketing. We do market research. I also source funding for startups. Thank you, Bonnie, for the connections and the conversation we had last week.
Yes.
And that's David.
Ian.
Hi, I'm Ian Garmes in Toronto. I am the COO of Virtual Film School, which is based in Los Angeles, and we're an online film school. And happy to chat with anybody who wants more information. I'll put my info in the chat.
Ken Deering. I guess I should do first and last names when I can pronounce them and when they're there. Oh, you're muted, Ken. Do you want to introduce yourself?
Yeah. Good morning. Ken Deering here from Seattle. We have our age tech product prevents forgotten cooking events for older adults who want to remain in their home.
Oh, thank you. Scrolling down my list. 1 second.
You don't start grease fires, huh?
We prevent.
Right. That's interesting.
Hey, Ken, I'd like to talk to you after or get your digits. I've got something going on for you.
Right.
Lee.
Hello, I'm in New York. Bonnie, we've met a few times. I get your newsletter. Thank you for all the great work you do. I'm a marketing strategist. I work in the Web3 space currently, but have come through all the way back to Web1, helping startups mainly think about their customers, how to connect with their customers, how to create content, and ultimately to get their call to action, whether it be selling products, their services, or taking action.
Thank you. Mark Weissman.
Great to meet everybody or see everybody again. Mark Wiseman, I'm Managing Director with Navidar. We're an Austin-based investment bank that focuses primarily with technology companies doing capital raises, sell-side M&A. We love to meet companies when they're early, informally help them. We're not consultants. We would let the marketing consultants, the growth consultants handle all that stuff. But some advice early on can help prepare for the exit or liquidity event when that time comes. So happy to be here. I've heard Joe talk before. I've spoken with Joe personally, and as everyone, those who know him know we're in for some good advice and information.
Yes. Always. R.D. Childers.
Yes, my background is manufacturing engineering. I do director of operations kind of work. Background in an interest in recycling and sustainability, clean energy, and robotics and automation. I'm a bit of a Rosetta Stone between what I call the carpet and the concrete, the people on the production floor and the folks in the boardroom.
Are you a Texan too?
Yes, ma'am. My name's Roy Dale Childers. I'm married to Laurie Joe in Hye, Texas. Look at that on the Google satellite view. HYE, Texas on Google satellite.
I love that accent. I really do. Sandra Kai.
Hello, everybody. This is Sandra. I'm a founder and CEO of Value, which is a Web3 talent incubator based in New York City. Happy to learn and talk to everybody. So,
Thank you, Scott.
Good morning. I'm Scott Purdy out of the Philadelphia area. I actually live in South Jersey. Those familiar with New Jersey, it's exit 3. I work with a company called Sine. Our product allows you to have multiple inputs from really anywhere in the world into one particular program, and then it will create a finished movie in a matter of minutes. And hopefully right now there's some similar products, but no one quite doing what we do yet. So we're hoping to be first to market.
And as a fellow former Jerseyan, exit 9, and I'm looking at your background. Was that taken down the shore, as we say in Jersey? We don't go to the beach.
We have a place in Ocean City. So that's just a shot from Ocean City. We'll be going there this weekend.
Oh, I'm jealous. Yusuf.
Morning, everyone. Hi. So I am currently based in Canada, in the Niagara region. I am a product manager by trade. Currently in between jobs, actually. I moved into Canada about 4 weeks back or so. So I'm currently looking for more opportunities and hoping to connect with everyone here, hopefully find new opportunities along the way as well.
Oh, thank you. I know Zarin is on 2 calls right now. I don't know if she can break away and introduce herself, but can you, Zarin? Otherwise, we'll have her introduce herself later. I guess not. Okay, Joe, take it away. Tell us about you and
we've got Steve.
Topic of the day.
Steve Schreiber hasn't introduced himself.
Oh, I'm sorry. He wasn't on my list. You must have come in late. I apologize, Steve.
That's okay. It's Hollywood Squares. I'm next to the host thing. But, Steve Schreiber. I got a 30-year plus career. I live actually very close to Joseph Katz here in northern New Jersey. I would say beautiful northern New Jersey, but it's not very beautiful today. So I can't say that. But I've got a 30-plus year career in senior management in startups and fast-moving companies, mostly service companies. My expertise is in customer impacting operations. So I help solve problems that are customer impacting across your business operations. I call it cradle to grave. So everything from onboarding all the way through to billing and collections, anything that impacts the customer, I've got expertise in handling those problems.
Oh, thank you. So, did I get everybody, or did somebody else come in and I missed it?
Andrea just showed up.
Oh, Andrea. Oh, she made it. She was having issues. Andrea, can you introduce? She was having mic and video issues. Andrea, can you introduce yourself?
Apparently not.
Apparently not. Maybe she'll be able to later. Okay, Joe. The stage is yours.
Well, for those that haven't heard me blather on in the past, my background is on the investment side. I ran a multifamily office for 20 years out there at 3000 Sand Hill. Joined a firm in 1990 and got enamored myself with my boss and my colleagues, such that when he died of cancer, I took over the company and bought it back from the European bank he had sold his firm to in the late 80s, the bank in Liechtenstein. And we were right there at 3000. We had prestigious clients in the venture world and the peripheral service professions because of who my boss was. He was old San Francisco money and just really a wonderful, wonderful man. And as the Silicon Valley money started percolating in the 70s and 80s, he was the go-to guy. And I just got lucky joining his firm. But it gave me a front row seat to the modern era of angel and venture investing from the view and lens of a money manager. We did our own securities research, built portfolios. You know, it was an old school money management firm. And I got very active in angel investing when it all took off. And a lot of the, again, because some of our clients were some of the central figures, just serendipitously. But always viewed through the lens of a pretty rigorous money manager. We were very good at what we did, very thorough, and our performance track records reflected all that. And it's been a journey of since, well, the late 90s of trying to figure out how to bring that love, more investment professionalism to how we fund innovation. The venture industry itself started out as a cottage industry and an apprenticeship model. And it's largely stayed the same without any formal professionalization that's ever taken place. There's no training, no body of knowledge VCs have to study. Angel groups are social clubs, but it's who the entrepreneurs have to source for money. And that's what we're trying to fix, is the very process in which how we fund innovation. That's what I've been pursuing with two different companies. I started a predecessor firm 23 years ago when I was still running my investment firm. Hired a CEO to run it, raised $1.4 million, got to revenue, had partnerships with venture firms and the like, but it was way too sophisticated, way too complex, and way too early. And so we shut it down in 2003, and I moved to Austin, Texas 10 years ago. It'll be 10 years ago next weekend, actually, Labor Day weekend. I moved out here and from Northern California, and restarted the old company. So it's called Angelspan and the Legacy Funds. The old firm was called Angel Legacy. My old investment firm was called Legacy Capital Management. And it's really about understanding the psychology of wealth, particularly old money. That was our client base. And I've been studying the psychology of wealth since college. Some people have suggested I write some books. I may be the world expert, which is not a very high bar to go over because I've just been studying it for so bloody long. But I also had a laboratory to apply the studies in the form of this old money multifamily office that then attracted a fair amount of the new money as it started percolating in the 80s and 90s. So it was a wonderful laboratory to apply the studies that I had been doing and continued to apply as I was philanthropy consultant and worked with old money, new money, female inherited, male inherited, blah, blah, blah. So that's the background. And I'm a compulsive researcher. So I tend to go off on tangents and then learn a lot about a certain subject matter. And then people want my opinion on it. It's just kind of my training and conditioning as a money manager, you know, fee-based fiduciary, trusted advisor, money manager, just to go do your homework. Don't express an opinion. Opinions are dangerous to have, and they're like belly buttons. Everybody's got one. When you're managing somebody else's money, you need to back it up, both just out of the sheer logic of it, but also just because we had power of attorney and full discretion on what we did with their money. They just trusted us with all their money, and then they said, just go do it. And so if you're going to go do something, you damn well better have research to back it up versus just some opinion. And so that trained and conditioned me to just do deep dives on different subjects. And it's something I enjoy. So restarted this company, as I said, almost 10 years, moved here 10 years ago, restarted Old Angel Legacy in the form of Angelspan January of 14. And what we built out is the components that are missing in these dynamic of entrepreneurism and investing in startups. So we can sort of mirror or replicate, or at least start adopting some of the more sophisticated practices that have been pursued and put to work in the public market investing for decades and decades and decades. simple things like building a properly diversified venture portfolio. Why is that important? Well, the research is clear. I mean, it's just in public markets, of course, you're going to build diversified portfolios. You have to, but it's also just basic blocking and tackling of best practices. It hasn't been deployed broadly in the venture asset class. Managing timing risk. Nobody can time the markets. Everybody knows that. Most every one of you have probably put ETFs or no load index funds in your IRAs or 401ks because no one can time the market. And your play money is where you pick some stocks when you think you can find a hot idea. Well, the entire venture industry is about chasing that hot ideas, picking stocks, which is abandoning the importance of diversification and market, managing the issues of market timing or the inability to do so through staged capital deployment, dollar cost averaging. So these basic practices that are, again, long since been sorted out in the public markets is what we build a platform to bring to the private markets. So that's what we do. And like I said, I tend to have opinions on a whole myriad of subjects, and I don't have anything specific. I know Bonnie and I talked about a specific agenda here or hit on some of the topics. Bonnie, I'll open it up to you to sort of direct some of the content if you want, or I can just launch off into some things. Oh, now you're muted.
I know that you can launch off into something, so you have the floor.
Yeah, well, Bonnie, as we were getting ready to, we got on early, there has been a lot of dynamics taking place in the venture world from a regulatory standpoint. Some of you may have seen the conversations around the SEC actually starting to implement some of the fiduciary expectations and behaviors and requirements of the private equity, broadly defined, private equity and venture, and implementing some more stringent expectations in the form of regulations. And that was came out of vote yesterday was one of the things I'd been following. Bonnie's been following it, and sadly, I guess the direction was to require more transparency. Transparency is a fundamentals of good behavior. It's a required component if you're going to have good behavior. And I'm talking about good versus nefarious, not just optimal investment results, but just as a check and balance over the sort of the evils of the human condition, because greed and ego and all these things do enter into the human condition when there's an absence of transparency oftentimes. Well, that's what the SEC was trying to do, was to implement a bit more, to model some of the requirements and regulations in the private markets of what's already in place in the public markets. And I was applauding that and watching it with great enthusiasm, because they're moving the direction that our platform literally was built to be able to implement, but much more rigorous, transparent processes, blah, blah, blah. Sadly, the lobbying took hold, and at the last minute, a lot of the raising of standards and expectations was diluted or neutered, as some people have suggested. So Gensler, as I read a piece yesterday, Gensler blinked. The really some of the most regulations with the most teeth that would expose the GPs to far more higher standard of expectations and give the LPs some legal recourse got neutralized. So they did incrementally do some fine tuning on the regulations of transparency, but the real teeth got pulled, if you will, on it. And but it's directionally in the right direction, which is, you hope that they're going to take multiple bites at this apple and move the industry in that direction. This was a step, which was not an insignificant one, but it was far less ambitious, or turned out to be far less rigorous and ambitious than they had originally made noise about.
I just posted a link from the Wall Street Journal.
Yeah, was that from today or yesterday?
I think that was yesterday.
It was yesterday. Okay, yeah.
Sorry, didn't get today's.
Yeah, so but what is happening is, just if we take a step back from that regulatory lens, for now, because I've been studying the venture world for 26-7 years since it took off in the modern era after the internet commercialized, so mid to late 90s, and what is that, 25 years? And all I've seen is basically three different generations of VCs follow the same bad playbook that results in booms and bust cycles, and a lot of FOMO venture investing, and continual inefficient process for entrepreneurs to source capital, Again, just a continual lack of professionalism. And that's the broad bucket I throw all of those practices, in part because the NVCA, the National Venture Capital Association, as we just saw its weight thrown around, has always been a lobbying organization for the venture industry. It's never been a professional standards and practices organization. It's never been in place to elevate the profession. It's been in place to protect the profession. And I've watched that unfold again, as I've had a very acute view of and study of the industry. That's what it's always been. If you look who runs them, they're always lobbyists. And that's the bad news, right? There needs to be basic professional standards, basic professional investment practices. Now, there are different firms doing different components of what's the research, the body of work that's out there and been out there for a fair period of time. What it says should be done if you diversify properly at the seed round or the A round or B round, whatever round you're choosing. If you diversified properly, what would your returns likely be versus this erratic and scattered history of the venture asset classes returns? So there's a great deal of work out there. And there's some, like I said, folks nibbling around the edges, trying to be more data driven, less driven by the cult of personality and who's got access to quality deal flow because they've got a great Rolodex and network. That whole social capital has been largely the narrative on how deals get funded and or sourced, which is just patently stupid. It's just patently stupid. You know, most venture capitalists, forget about angel groups, most VCs out there investing in the seed and A rounds, they say, if you find a lead, let us know. We're interested, but we don't lead.
Right.
How many of you have heard that narrative or seen that discussed? Well, that is literally a tangible admission that they don't know what they're doing. They don't know what they're doing. We did our own securities research as a money manager, right? But I never called management. I never will talk to Wall Street analysts. We had access to data that we would seek out the flavor of stocks that we knew their data could help us identify, and we built portfolios. And we have great performance track record. And it was all off of a dashboard using data. I never had the managements of Cisco and Intel parade to my office and come pitch me on the company before I bought the stock and put it in my clients' portfolios. And even if they did that, nor did I then, even if they came, did I look around and see who else was buying Intel before I went and bought the stock? I didn't give a rat's rein who else was buying Intel, right? If it was a choice I was choosing to make. Or if I was one to sell it, it was already in our portfolios. I didn't care who else was selling it, right? Because I knew what I was doing. I had access to good data, and I understood an investment process. That's what's lacking in the venture world. And again, I think that this last blow up is, fingers crossed, going to be the last one where they keep flogging the old model. Just a new crop of VCs show up and still flogging the old model. Now we're going to see, and we're starting to see, we're going to see more and more, closures of venture funds, or venture funds that don't get their follow-on, that finish out their funding rounds, or people that launch funds at a $20, $30 million fund and then they don't get a second one because the results were so bad. So we're going to see a contraction of the industry. We're starting to see some of it. That's the good news. That's what we need to see. I also lived through and watched from a front row seat Kleiner Perkins when they were gods back in the 90s, 80s and 90s largely. They were gods. And then ego and greed and the amount of money they had in management blew up Kleiner Perkins, and they're still limping along and trying to find traction again. But they've come down off their pedestal in their heyday, and that's 20 years ago. We're seeing the same things, I believe, in Sequoia and possibly / probably Andreessen, because of the same. And again, these are Shakespearean plays that just unfold right in front of you. If you have a reasonable objective lens and don't get caught up in the cult of personality, you can see the patterns of both behavior, and then you know how that movie ends. And that's, like I said, that's what I believe we're seeing. Now, the bad news is, again, this is the third cycle I've observed. The bad news is the entrepreneurs are the unwitting victims and all that. They're the heroes in capitalism, not the VCs. Right, and not even the money sources. The entrepreneurs are the heroes, and they're actually the ones that bear the brunt of all the bad behavior of everybody upstream. And that includes investors that allocate capital to some of these venture funds because they do it in a lazy way, whether you're an individual or some of the pension plans. I mean, one of my board members And investors is a man named Mel Carter, and he runs the venture fund of funds practice for a very large consulting firm out of Chicago. He lives here in Austin. Yeah, the firm is called GCM Grosvenor, and he's been doing it for almost 20 years. He sits on the board of over 60 venture funds and has LPAC, Limited Partner Advisory Committee, LPAC, a board observer rights through the LPAC on another 40 plus. So he's had as good a view on the venture industry as just about anybody as an allocator, building and managing fund of funds for big institutional pools of money, sovereign wealth funds, pension plans, and the like. That's who Grosvenor's clients are. And again, he is a great window on the industry for me. And it would shock you if you really saw how unprofessional so many of the venture firms are. It would absolutely shock you. Now, the bad news is, again, we've lost time and a misallocation of billions and tens, if not hundreds of billions of venture dollars when other countries are catching up and or lapping us in what they're funding, who they're funding, their efficiency of their funding cycles. So I believe that we're at an important inflection point. Partly fingers crossed because we're building a toolkit to try and take it into a more modern era. So there's a little bit of a pitch in my own book on this. It does influence my perspective, I have to admit. But I think there's enough evidence also to suggest that the old model is probably not going to get rebuilt or replicated when we have the next cycle. There's a whole lot of things happening in building out the infrastructure to create secondary markets for venture funded companies and or the LP interests of venture funds. There's the infrastructure like the equivalent of NASDAQ getting built for private assets. So there's a lot more folks building out different components, the plumbing and the infrastructure, so that more professional practices can be pursued in the private market. So that I think there's ample evidence to show that we haven't seen this level of build out in prior cycles as they've blown up. So again, you're going to start seeing a lot more conversations where if we have any say in it, you're going to see ETFs that look, that are venture funds that'll have a secondary market liquidity and more efficient pricing and more rigorous and efficient pricing mechanisms. So you can price it. It won't be an actual ETF that'll be traded for a long time, but they're called closed-end trusts. And these fall under what's called the 40 Act, the Investment Company Act of 1940, that defines pooled assets, mutual funds, ETFs, closed-end trusts, unit investment trusts. These are all called 40 Act products. We're going to start seeing 40 Act products proliferate in the venture asset class. We're going to start seeing it being treated like an asset class versus an access class, where you got to come through me. I'm the smart guy VC that's got access to quality deal flow because I've got a great network, right? That's an access class, and that's how they perpetuate the narrative around the venture asset class. You need the power law. No, you don't. If you built a proper portfolio, it's clear you don't need a power law outcome to deliver good results for investors. It's not a requirement. It is an archaic fact of a flawed venture fund model. And the data is really clear on that. But they've been able to perpetuate that narrative for a very long time. So I know I'm bouncing around here. Entrepreneurs themselves, they need to level themselves up as well. The Pitch Fest industrial complex is not going to be enough. Entrepreneurs also have to professionalize how they comport themselves and try and mobilize and catalyze the actions they're looking for, whether it's investment dollars or that mythical value add, or if you really want to extract the value you can extract from the mentors and advisors, many of which are on this call. That's the profession many of you are in. Unless you know what's actually going on inside the business, and you've got somebody that's both coachable and will listen to you, you can scream all you want on helping in their marketing, go to market, execution strategies, everything else. But if they're not coachable, they don't listen, it doesn't matter. And that is unfortunately a big, big, big component of the entrepreneurial experience and journey. Is so many of them well-intended get caught up in, they're so busy and they got so many things to do, but they lose sight of really how to effectively execute the startup journey, regardless of what they're pursuing.
Joe, sorry to interrupt you there. Can I
yes, please.
ask you on that point about the uncoachable founder, co-founder, I've personally experienced more than I want to count. You also referenced data earlier in the dashboards that you use to help investors measure successful companies or how companies are investable or not. Where does the coachable CEO founder fall into that metric? Like, what data do you have to tie that to?
Well, I'm going to make one more connection, then I can reference data. In fact, I'll just it in the chat box. I know Bonnie likes to share. Yes, Bonnie?
Oh, I wanted to make a comment. I can't tell you how many clients I have turned down because as I'm trying to work with them or trying to tell them what they are just not coachable. Now I know the investors to whom I'm making with whom I'm making the introductions. They're going to be pissed off at me if I send them somebody like, and I don't work with them. I already know how that story's going to end. I have read the last page.
Yeah, well, this is one of the things that I've talked about when I say that the marketplace has to level themselves up. Entrepreneurs have to raise their game of professionalism, but so do investors. They shouldn't chase shiny objects and then want somebody like you or some of the other professionals here to bail out their bad investment. Hey, go help this company, you owe me, or I'm expecting you to go do this because I referred them to you, when you know damn well that they shouldn't have invested in the first place, because you can see how this movie ends. I've seen that time and time and time again, but investors themselves need to raise their game and not just get caught up in chasing shiny objects. That's the hard part of the investor side. And yes, that's partly what we're producing, our tools to execute on that, but I'm not here to talk about what we're doing. So I'm putting up, Joseph, to your point, I'm putting an article that was covered in TechCrunch, covering some research about how can you spot an entrepreneur that's likely to be coachable and thus be willing to process the information feedback loop that comes from the value add, whether it's from investors or mentors or other professionals they've even hired to actually implement whatever they've been offered. And the litmus test for spotting somebody that's likely to be coachable, that's likely to listen, likely to execute, is the evidence of proper and voluntary transparency. Is that CEO of that startup offering any degree of consistent, unsolicited insights, i.e. just updates, monthly updates on what's going on inside the business?
That's definitely insightful. I'm just thinking about my most recent personal experience on that front. So yeah, transparency would be a good telltale sign.
It's the first thing that everybody this is some of my go-to-market selling is if you're providing resources to an entrepreneur that they want, and I call it capital, either it could be financial capital or human capital in the form of your expertise. If you're providing that, you should use as your screening on who you're even willing to provide it. Show me your last 3 monthly updates. If they don't have it, you don't even start with your advice or whether you're going to take them on as a client or a potential investment. Why not? It's all over the internet. There's tons of things. They even hear this if they went through an accelerator, how important this is. Unfortunately, the accelerators are too busy also telling them how to pitch at demo day so they can get the next class of cohorts through. But you see this in an entrepreneur that doesn't understand this. Either they're not a serial entrepreneur, they're a first-timer. And as a first-timer, they haven't done their homework on their responsibilities and expectations as CEO of a startup. They just like being called a CEO of a startup, but they don't understand the responsibilities of the job. And that's just you're not telling them no. You're not saying, no, I don't want to work with you. You're saying, here's the research that says you need to be doing this, and it's my litmus test to see if you're somebody I can be effective working with.
You know, I read a newsletter not too long ago, and there was, how many articles have you seen, the top 10 reasons why startups fail? And not one of those lists mentioned the number one thing, which I feel is the founder doesn't listen.
They don't listen.
They don't listen.
They don't listen. And the litmus test to see if they're likely to listen is, are they voluntarily transparent?
Right.
Because it is an active gesture of eliciting feedback by communicating and offering the communication outward first.
Not to insult any CEOs on the call, but some of that also goes back to their egos.
Oh, well, yeah, the causes are myriad as to why they're not. I've got a spectrum that I've sort of put entrepreneurs in, and there is a bucket that says they don't know. And that's a minority of them, by the way, is they don't know the importance of this. But those that do, they fall on a spectrum of bad as to why, as far as the reasons as to why they're not. And it can be naivete all the way up to, yes, they're hiding something, right? A more nefarious reason for the obfuscation or avoidance. But at the end of the day, it's none of it's good. On that spectrum, none of it's good. So we've got is it Daryl?
Daryl.
Got a hand up. Did I
Hi
pronounce it?
there. Hi, Joe. I just wanted to add to your most recent piece here. So obviously it's a very strong piece in your presentation. I was involved with doing personal advisory services, but much different than what you people have been doing. It's in a very volatile industry, and that's the commodity space. And we have some very large operations now that have grown organically. They've grown to huge acreages, huge feedlots. And of course, managing the inventory and market risk is probably last, right at the bottom of the pile. So you can imagine the amount of financial leverage that's against these operations. It's high. So if you are caught up in the day-to-day of managing the physical asset base, the plant, the men, the equipment, all of that, how much time do you think you would have available to you to be actively managing the risk on your inventory portfolio? Virtually none. Now, I did this job as a young man for CSB Foods, which was the largest canola crusher in Canada. And I was challenged even within the firm, having data coming to my desk every day, managing this derivatives portfolio against the physical inventory with the freight department and everything else. Now, before I ventured into doing this service for them, I did just exactly what you said. If you are not transparent and do not want to provide me with the information to start, and if you're not willing to provide me with active updates, then I will help you to get the tools to do that. And you should have a dedicated person in your operation that's going to keep that information up to date. That person and I can go over it together so that we don't bother you too much because you're the CEO of the whole outfit. But when we're ready now to make some strategic moves, then we want you to sit down, look at the information objectively, and you make the decision. I am not going to trigger that order for you. You give me the authority to, though, and you have to. Because once we say go, it's got to get done. No fooling around. So I worked on this for a few years. I think I had about 10 clients in total. And the number of participants that were willing to do the required transparency that you used was limited. And some that did would drop out fairly quickly, fairly fast. Ended up with just one. And so I quit. Now I'm going to challenge, the investment community, the advisors and all that kind of thing, because I didn't have time to look after my personal equities, myself, doing this kind of work. So I got out of the whole thing, and I will say to you that I manage all my own equities for myself. I'm doing it as we speak right now. And I have a routine and it reports that I work for myself day to day. And I am challenging the idea of this buy and hold and this, just like you said, chase this, chase that, chase that. I don't chase things. I pick things out. I strategically pick entry, exit points. I really don't care what the heck is all going on out there. To me, it's a flow of money. The money flows to something and it flows out for whatever the reason is. Don't matter. Maybe it's Tuesday, 3 o'clock. It just people want to sell something. And I've been doing so much better over the last 5 years and mentally feel so much better. You wouldn't believe it. Huge. Now, not everybody can do this. Not everybody wants to do this because it's a full-time job. But I have managed to find time to meet with Bonnie and the Diffuse TAP group because I'm going to need to do some of these things for the larger project that I'm working on, besides my personal stuff. And it's very valuable to have a team around you of experienced people. And anyway, that's my my input, first time visit. Thank you very much, Joe.
Sure.
You know, I wanted to give Milam and we have Andrea a chance to introduce themselves if they can. I'm sorry, Andrew. I know was having technical issues and Milam got here late. So would you like to, Ayla?
Andrea, you want to introduce yourself?
Oh, sorry. Sorry, I missed that. Yeah, sure. My name is Andrea Liu. Used to practice law and immigration and corporate. But for the last several years, I've been working for a single family office. We're a bit of a generalist, so we've been looking at disruptive technologies across various verticals. More recently, it's been ad tech, consumer tech, and yeah, I mean, so those are good for now. And then occasionally sports tech. Been working with some of the sports team owners for potential trades, as well as some commercial real estate, trophy assets specifically. Yeah, based in New York and Bay Area. Been fairly bi-coastal of late. Good to see everyone.
Thank you.
Hi, thanks.
Ayla, would you like to introduce yourself or?
Hey, sorry, I'm having some technical issues.
Oh, okay.
I'll be on in a few minutes.
Okay, just let us raise your hand and we'll have you introduce yourself.
Yeah, I might have to join from my phone. Thanks.
Okay, in the meantime, Scott Purdy has his hand raised.
Yeah, I just had a quick question. From a VC's point of view, what would be like the main attributes, characteristics, or duties of a good CEO that you would consider working with?
Well, from a good VC's perspective, let's characterize that because VCs are not I mean, if you talk to one VC, they'll parrot the next one, but most of them don't know what they're doing or even what they're looking for because so many of them are followers. So to be blunt, most VCs are looking for something that has the optics to make it look like why they invested was obvious, whether it's the rock star profile of the CEO because he or she worked at XYZ company prior and or who else is on the cap table. Because again, I've seen time and time again, what they claim they look for in their due diligence versus if you look at the actual profile of their portfolio companies are two different things. So what they say versus what they do are so many times two different things. It's because they haven't had the rigors of professional standards applied to them. And part of that is the transparency of their investment portfolio and the process that they assembled the portfolio. As an old money manager, we had consultants come through. Now we had the SEC come through every 5 years. And then we had consultants come through and do an audit of your process. So when you're looking at your track record from 5 years ago, you've got to have an audited process that of the people that were involved in making the decisions, the research tools you used that went into the selection of those stocks that went into the portfolios that created that track record. Because otherwise the track record's useless. And the VC industry is, like I said, it's on such an area. So the quick answer is I can't tell you because I don't have a great deal of confidence in what they claim versus what I really have seen is what they actually invest in.
Some of it seems ego driven, what somebody else is invested in.
It's social capital. If you dissect it down, I've tried to do some reasonable study on this. And if you really get to the psychology of the motivations, the triggering points in their decision making, it's, in fact, this is not even my label. I saw a gentleman do a write-up on this, and it was around Silicon Valley, but I think we can apply that ubiquitously, it's social capital. What's in it for them as an individual GP? Because it's not about the returns. So many of these guys are so bloody rich. The junior guys are the hustlers inside the firms, but the social capital, and this is a true story because one of my clients I managed his family money. He was that first guy Silicon Valley Bank handled to be the liaison between the bank and the venture industry. And he was hired in the late 80s. And when I joined that firm in 90, his parents had been clients of the firm I joined. And he was my age. He was a contemporary of me. We were the young Turks, the late 20s, early 30s crowd. But he was the guy originally. He just retired. He's 63. He just retired from Silicon Valley Bank about 2 years ago. And he told me stories in the 90s that he witnessed of literally a VC investing in the term sheet of a deal because another VC asked him to. And that VC says, I need you to invest in this. Remember, I donated to your favorite charity, so I want you to invest in this deal. Now that VC is investing LP's money in a deal because of social capital. This guy supported your personal favorite charity, so now you feel obligated to invest in one of their portfolio companies. Or access to the jet because they wanted to travel with them up to Lake Tahoe for the weekend. These are actual stories of what does go on inside the venture industry. And that is rolled up into what is generously labeled social capital.
It seems like some of that just generates enough momentum that companies that get picked have enough buffer to survive their mistakes.
Yeah, they can get masked by money until it can't. And that's where we have a misallocation of risk capital so often. It's literally colossally inefficient. And
just pointed that some of these, whiz kids are simply a function of they have got enough money and momentum by virtue of this social capital, the stuff you speak of, that they become the unicorns by virtue of having enough buffer.
Until they're not. If you look at WeWork, for example, or you look at some of these others that were high flyers because yes, they were overinflated with access to capital, but that didn't make them sound businesses. That are just, we got a couple hands up here. Bonnie, you want to quarterback those, or you stepped away? Ian.
Oh, I'm here. I'm sorry. No, it's raining here, and I sometimes.
Joe, you mentioned in your remarks that some other countries are lapping the U.S. in terms of. So, can you give us an example?
Oh, well, Israel is the most obvious one. Yes. Israel is a rock star. They're funding real stuff, and there's a great book called Startup Nation that talked about how they went from a standing start in over about 10 years, literally were the most innovative entrepreneurial country in the world. And what they're funding, the per capita dollars get mobilized for startups, how many startups per capita, how many people in their country, all the sort of metrics that you can normalize on. They became number one. Actually, before that, believe it or not, it was Iceland.
Wow.
On a per capita basis, Iceland was the most entrepreneurial country in the world. Now, we used to be, but we've exported entrepreneurship and to a certain degree, the venture capital process. And other countries are taking it and being better with it. We're just flogging the old model because the money's got so big and the egos got so big and the celebrity culture and the media hyping and all that sort of crap, which doesn't happen in those countries to the degree it does here. And that's the fuel to a lot of this FOMO as well. So,
well, the fall. You've made some comments about the venture capital sector, but isn't what you say to a certain extent true of American business in general?
Well, thank you for saying that, because as Daryl was going off and talking about, public market investing, I was a securities analyst for 20 some years. I've seen really bad management in a publicly traded company. So, because there's bad management and private companies are bad, I've seen really bad investment practices in investing in public companies as well. So this area that isn't just exclusive to the private asset venture capital industry, but some of the glaring gaps are what continually perpetuates the absence of improvement in the venture funding process. And that's this lack of professionalism, right? So it's not going to eliminate the bad practices, but it's actually going to make the it's going to be easier way to get rid of the bad actors and or those folks that actually don't know what the hell they're doing. So entrepreneurs don't waste their time talking to them. And then there'll be different instruments that'll show up that'll improve the process of how entrepreneurs source capital. Janice, I think you got your hand up.
Yes, thank you. This is a great discussion. So thank you, everybody. And thank you, Joe. My question is about patents. And I'm noticing how there's a lot of challenges right now with the U.S. Patent Office. And I'm seeing smaller companies getting stripped from their patents in favor of going to giving the proprietary information to a larger company because they have the dollars that can afford that. And the U.S. Patent Board that was started is a very closed organization. Are investors looking at proprietary assets like a patent that in their decision making, they used to me be like the gold star standard, but now it's feeling like it's being hit below the knees right now, and the U.S. is now like 26th in the world for for patent strengths? And do you look at companies then maybe getting a patent overseas and strengthening? In fact, China is actually rising up and protecting their patent holders and the intellectual property. Can you just speak a little bit to that, and if that is attractive for investors?
The question being overseas patents first and secure them overseas. Is that what the question is?
Well, the question is, like, I feel like there's not as much weight being put into patents here in the US. And then is it far more attractive, like if one were to then say, okay, for example, for my work, to go overseas and secure patents in foreign lands to, is that therefore more attractive because the US is not a strong country anymore in protecting intellectual property rights?
Wow. Well, this is outside my expertise. I'm not a patent lawyer, and my knowledge isn't that current at the ground level. Having watched this evolution over time, I would say that, like I said, this is taking it into a slippery slope. Enforcing the rule of law is critical for a country to become a developing or developed country or remain a developed country. And that's been well studied. It's one of the 4 principal components necessary: a stable currency, the rule of law, separation of science from religion, and a robust infrastructure, transportation, communication, and I mentioned the stable currency. Those are the 4 components that have been well identified that are necessary components to be in place. In the absence of any one of those, you can be a developed country that starts slipping, or you can have 3 of the 4 and you work really hard, but you never really get over up and become a developed country. You're always developing. And I think of some of the South American countries, Argentina and Brazil are the most glaring examples. Why the Middle East can't sort themselves out is because the religion dictates so much of the political and business practices. You need to have the separation of science from religion. You need to have your own religious enlightenment, and Islam hasn't had that yet. So it dictates so much the activity in the Middle East. What you're describing is essentially a slippage of the enforcement of the rule of law in this country, and that's not just in the world of patents. Our legal system has been captured like so much. Money dictates justice, right? It has nothing to do with justice. It has to do with money.
This meeting is being recorded.
And so, hey, Mr. Jones. We had a fun visit. Holy cow, he's an interesting dude. So, you're asking a broad question. I have watched this slippage happen over the last few decades, but that's not just our rule of law legal system. It also has applied to our healthcare system, our education system, our political systems also, where moneyed interests have captured so much of what dictates the activities on the ground in the moment, which is some of the questions you were asking about. As far as a strategy to do something overseas, to secure it overseas before that's beyond my pay grade. I know a good patent attorney that actually has a real strategic view, and I think he's in Europe somewhere. So he's not just a product of our system. Very thoughtful guy. If you want an introduction there, he could probably give you more strategic insights on what, some of your questions, because that's way past my pay grade.
Thank you.
We have a couple of new people in the room. Elam is back, and Tom Jones hasn't introduced himself either. So, Elam, do you want to introduce yourself?
Yeah, happy to. First of all, thanks for the interesting conversation. I connected with Joseph earlier this month, and we had a pretty riveting chat about everything tech, healthcare, I guess the tech hub in Israel a little bit. I'm originally from Israel. I've been in tech for about 10 years in various roles in leadership as well as sales. I work predominantly these days as a career coach for people in tech who are either mid-career or new managers who are looking to advance their career. And I find it really interesting to be in these conversations because most people here are seasoned veterans. And so it's interesting to see from a top-down approach what challenges are arising within the space and build a deeper understanding from another angle of what my clients are facing.
Mr. Jones, Captain Jones, or is it Admiral or?
Just an ensign,
Ensign.
Good morning. Hi, Bonnie. Thank you. I've come with Zarin, my colleague, on a new notion we're working on called Fair Share. My background is I was a journalist and a film director, which I continue to do. Fair Share is a very ambitious undertaking we're in the throes of. So I'm all ears. And Joe and I got a chance to meet the other day for a quick, I don't know, 2 hour
chat. Yeah, we started out with 30 minutes on the Ross Perot campaign in '92. That's how that conversation started. So that was interesting.
It was great.
That was a treat. I got to tell you, Tom, it was so much fun.
Are you back from Ventura? You're back from Ventura, right?
I'm back in Austin now. Yeah. I got back Tuesday night late. So yeah.
How'd you like the earthquake and the flood? You were there for a good time.
Well, I got the full California experience. Yeah, I spent a weekend in California, Tuesday to Tuesday. Got back a couple nights ago, and yes, I did. So, as I like to say, did some hurricaning, did some earthquaking, had a full California experience, and walking on the beach.
They're going to call you earthquake.
Did you So did you shoplift? That's part of the California experience now too.
Yeah, I didn't see any shoplifting. Sadly, I didn't see that. We were in some pretty nice areas, but yeah, it was. I know I didn't feel it. Although my daughter, part of why I went out there, she lives in Oxnard, which is just right by Ojai.
Yeah.
Where the epicenter was, and they felt it, but nothing rattled even off their shelves. You know, they found one wine store in Ojai that had some bottles fall, and that was all the news coverage was the clips from this one wine store in Ohio, in Ojai, that had some bottles fall. So you had the glass and red wine on the ground, and that was the evidence of the tragedy of the earthquake.
Yeah, okay.
And the hype over the hurricane hitting LA Basin. It was hilarious. I could go on for I was staying with my old college roommate as well out there. He lives in Santa Monica, and that's where I spent about half my time. And we wandered around Saturday or Sunday morning before it got really bad. And walked down to the bagel store down there on the Santa Monica Boulevard and literally, just made fun of all the media hype that had been going on overnight because the rains were nothing. There was like 2 palm leaves that would fall in the middle of the road, and that was the carnage that hit Santa Monica from the hurricane. Right? It was a hoot. Anyway, yeah. Sorry about that, folks.
Yeah. Well, thank you for the invitation, and I'm all ears. Thank you very much.
So Zarin also can introduce yourself now. So
yes.
Zarin.
So I'm based in Switzerland, and I have a banking background. And currently I work with a couple of companies for strategic partnerships and business development. Most of my time is with, Fair Share ecosystem and Tom and Amit. So we have now daily calls, looking very exciting. And yeah, so, and a continuous participant to Joe's and Bonnie's calls to learn more and more.
Do you have a question?
These are the adult networks.
Yes.
Yes, exactly.
So next question.
Yeah, are there any other questions? I know, like I said, we just kind of conversations weaved in different directions, but these we're in a very interesting place, both at a macro level, meta level, macro level, and a micro level in the venture world in particular. This will correct itself. The good news is, and Serena sits in on some calls, and I think there's some other folks here that sit on a group called 361. And there's a lot of smart financial people around the world that's part of that group, and families and investors and that, anyway. In one of the prior recent chats on that, we were talking about the issues of inflation, the economy. Is it going to be a recession? Is the market, all that sort of market-based macro conversation. And one of the things it's a fairly well-known fact or set of conditions, if you will, is that the backdrop of the economy doesn't affect the entrepreneur, meaning that it doesn't affect their ability to build their product, doesn't affect their or interest rates or changes in the stock market, doesn't affect their activities of building their business. It does affect their ability to raise money, because so often the investors that are the casual drive-by investors they're subject to the whims of the headlines. They're subject to the mood of what they're reading about is going on in either venture funding or the economy or whatever else. So they're very emotion driven. And you can throw it all into what's called the wealth effect. They don't feel wealthy, they're not going to invest in startups. Right. So that's what causes and provides an order of magnitude to the FOMO effect and then the whipsaw when it goes the other direction. But at its basic core, all that backdrop noise, economic macro stuff does not affect the entrepreneur. That's the good news. And yeah, there's a lot of noise out there, a lot of weird stuff going on at the macro and meta level. But the good news is also when you dissect it all down, it's when we've gone through periods like this in the past, it was always the entrepreneur that was both the survivor and then pulled things through. So we're all sort of operating in a mission critical part of, I think, where we're at in the economic cycle. And this is not going to, it's going to take a while to work its way through because there's a lot of fundamental forces going on here. But again, at the macro and meta level. But at the end of the day, we're all sort of on the side of angels in working with entrepreneurs to help entrepreneurship be more efficiently successful because it's going to become even more important over the next 10, 20 years, given what's happening at the meta and macro level. So I can nerd out on that conversation, but
I had this question following up on that. Like we had a recent call also with someone that there was a private banker based in the US saying that there is money. You know, there's a lot of money that looks to be deployed. It's not that there's no money, but also when you talk to the founders or even people with revenues everywhere now, like and globally too, there's lack of funding is taking a huge amount of time, and it's just even successful repeat entrepreneurs is always the same. So what is it that will make that money kind of go into motion? I mean, obviously, like they can get I don't know 5% at treasuries. For example, what is it that will make, you know, uncertainty is also there that will make that money kind of move to what type of maybe reporting or projects?
Yeah, well, again, I always think in terms of it is on an investor by investor basis. So generalities are difficult and dangerous. However, there are some basic laws of nature in money flows, right? How can you direct money flows? And one of the phrases that is absolutely accurate is money goes where it is treated best. Now that's a really important concept to unpack, what it's treated. Who's treating that money? Is it the investment results? Is it the organization they gave money to, the investment firm or the entrepreneur? It's also the tax location, Texas versus New York or California, or Singapore versus other countries. So tax implications of an impact on money, where the money is treated best is where it flows. That is a law of nature, the laws of physics, basically. It's like water flowing downhill no matter what. In the world of venture capital, the process of investing is so cumbersome and the historical returns have been so bad. That's why we have such a limited amount of money actually flowing. And the process is that flow is colossally inefficient, which is what we were talking about earlier. So when we can present a path where the money is treated better, then there is a huge pool of money that's going to want to move into this. And I'm talking about early stage venture. We saw the whipsawing effect of the late stage venture, right? With the Tiger and Co2 and the SoftBanks and stuff chasing those late stage deals and doing what they did to that end of the venture curve. But what remains the most inefficient is this early stage. And there hasn't been an effective way for the money to be treated well, to flow to these early stages. And again, I always try and give you a cautionary tale. This is what we're building, is what we believe to be a way to allow for that money to flow better because the money's going to be treated better in the context of the Angelspan solutions, the IR, and then the legacy funds platform. So if you're not treating the money well, it's going to be episodic, it's going to be social capital, it's going to be FOMO, it's going to be chasing, it's going to be greed, it's going to be a lot of these more less than elevated motivations that will define the decision-making process. And that's what I've witnessed for 30 some years. Mel Carter, my board member, talks about this. He quit taking engagements from sovereign wealth funds and pension plans that wanted him to build a venture fund of funds because the industry got so bad. They quit taking engagements in 2019 before the bubble because he saw what was coming. So he would not take clients that wanted to go build a venture portfolio because they were basically jumping in right at the top and he knew it. Okay. So that age-old thing is money.
Oh, that's impressive.
What's that?
What you told is impressive to me. That someone like can resist that, may have that insight and make the right decision and execute the right decision.
Exactly. And that's what's lacking in is that level of adult behavior in this venture asset class. You get it in the public markets. Now, there's still plenty of bad actors. Don't get me wrong. We're talking about statistical, percentages of the actors is all I'm talking about. You can always find bad actors no matter where you're at. That's what industry or regardless how transparent. But in venture in particular, it's not as populated as much by the bad act. There are bad actors, of course, but as much as just childish behavior and highly unsophisticated practices that causes this whipsawing of peaks and troughs, with the entrepreneur being the roadkill along the way because the investors are not investing well.
Yep.
So there is and then we're going to start seeing, when you think of the institutional pools of money, the foundations and pensions, who have an actuarially required return they have to try and achieve. They have to invest money to get a certain nominal level of return. Pension plans typically have about a 7 to 7.5% assumed rate of return on their pension assets to maintain their ability to support the retirees. Foundations have a similar actuarial requirement of producing a 5% distribution rate out of the foundations. It's required. And that means they need about 7 to 7.5% return because that additional delta means it's paying for the staff and the salaries and the cost to manage the foundation. So they're very similar math. And where are they going to get a decent risk-adjusted returns in the bond market at those levels? Because they do have to factor in inflation. These are long-tailed pools of money. So inflation, they're looking for real returns, not just the stated nominal return. So there's going to be a massive amount of money looking for better rates of return than what the public markets have been able to deliver over the last 30 years. That's coming. The money is getting positioned and trying to move around to be able to capture it. Real estate, you can't buy institutional real estate anymore. It's all going to be project-based because of how much low interest rates have inflated asset prices in the real estate market. So the biggest pools of money are going to be scrambling to deploy someplace else. And there is no shortage of money in the family office pools of money as well to flow to entrepreneurship and early stage startups if it's going to be treated well. That is the point. And that's what hasn't been taking place. And that's what we're trying to build is a mechanism so you can actually accommodate serious allocation of capital. It's treated like an asset class. Risk is being managed properly. Structural transparency is not only at the fund structure level, but also at the individual portfolio company level. So there's transparency up and down the asset that these investors will be allocating capital to. So these are all the structural components that we built to treat the money better so it will flow better. And the irony is that if you just invested, the research is clear. If the portfolio strategies were just more risk management oriented versus swing for the fence power law chasing, the returns are unbelievably compelling if you want to take your own ego out of it and actually be more about risk management and investment process. The returns are there. And ironically, the very structure of an optimized venture portfolio supports more startups because it incorporates, wait for it, proper diversification. So instead of rifle shooting, you're actually supporting more startups because you want a diversified portfolio. So it's ironic that the best investment practices will be improvements in the overall ecosystem practices and construct. And that becomes a virtuous circle where more money, more velocity of investing, because you're supporting more startups, you got better investment returns, it attracts more money in. And that is what Silicon Valley had 70 years to figure out and hone. And then it's gone off on its, I think, some of its tangents along the way. They were able to create this virtuous cycle of money that was made and got reinvested in the system.
Then they became rock stars.
I'm sorry?
Then they became rock stars. It was the rock star syndrome.
Well, that's right. Well, you have the old guard would retire because they made so damn much money, and then the new folks would fill that vacuum, and then they would get lucky with the next tech cycle, and the winners would become rock stars, but most of the money would get pissed away. You know, I mean, that's that cycle that has rinsed and repeated through. Now I've watched 30 years, or almost 30. But that is why you also have such episodic returns and such an inefficient flow of capital and such a limited amount of serious money allocated to venture asset class. Because if you look at what blew up the total venture funding numbers, it was just a few firms, the Cotus and the Tigers of the world, that were distorting late stage, writing huge checks, distorting the total venture capital money getting spent, and it was all in late stage stuff in a concentrated number of holdings. But when you really look at the seed and A round stuff, the volume of dollars has not grown nearly like, obviously, the later stage stuff. That's because it's the most inefficient asset class and the hardest place to invest well. But there are solutions on the way. Hopefully, we're bringing one of them to market.
Yusuf has his hand up. Yusuf, you want to ask?
Yeah. So, Joe, firstly, thank you. It's been a very insightful conversation. You've seen past booms and busts. One, which cycle does this most closely mirror? This current bust, both on the VC side and the public markets side as well. And on the other hand, where do you kind of see the horizon? Where do you see that first ray of sun coming up? So, which is an indication that, it could possibly end up being another boom cycle, and we are potentially out of the buzz cycle.
Okay, I'll try and unpack. There was a lot of moving parts in there. I really hesitate to try and, again, predict the future. I do study the past to try and identify patterns, and that's both the economic cycles, investment cycles, and the human condition broadly defined. One of the smartest people and again, understand my observations are a synthesis of me studying a whole lot of really smart people that I'm always trying to find. And one of the smartest people I've ever encountered, and I've never met the man, I've had a brief email exchange, is a man named Daniel Schmachtenberger. He has as good a broad view of the human condition, economic cycles, cultural cycle. I mean, this guy's brilliant. And we are in, I don't know if there's another guy that wrote a book, The Fourth Turning, that speaks to some of these same topics, where we are at several short, intermediate, and long cycles are all converging right now. And we're going through this really a cultural shift, economic shift, political shifts. It's all happening right now. It's partly what we're in the middle of. So what's the ray of hope? If you're looking at it from that perspective, the ray of hope is the end of the decade. It's not going to be easy, folks. We're going to be according to them and their work, it's going to take till the end of this decade to sort through all the structural shifts taking place. And it's not going to be without a lot of pain along the way. Now, again, pain for who? It doesn't have to, I'm not saying everybody's going to experience the pain, but it's not going to be easy. I guess I was touching on the ray of hope is entrepreneurship. It has always been the solution. And that's going back to what I said earlier, is that we are all on the side of angels because we're not working for a big corporation. One of our partners that we're getting very excited about is an organization called Figure. And Figure is, a big successful startup firm. They've raised tons of money. The founders were the co-founders, the husband and wife team that founded SoFi. But they just laid off 20% of their workforce. And without really any notice. And these were some senior level people, just got carved out. They didn't have control over their own economic future. Entrepreneurs can and do. So the era of working for big companies is over, where that is a comfortable place you can work for 30 years and then expect to have a sound retirement and go off in the sunset. Now, it's taken a generation to train people away from that psychology. there's enough of us old people on this call that can remember being a company man and working 30 years was something that somebody might be proud of. A husband would come home, and oftentimes a husband, of course, would come home and be proud of the fact that he's got 7 more years to retirement and the pension plan's in place. And honey, we get to go off and do what we. That era is gone. Now that's the good news. It does take it causes some pain to retrain people to think, no, you got to take personal responsibility. And yes, it can be scary as hell at times, but there's nothing more liberating than and more profoundly human than taking personal agency over your own economic future. That's called an entrepreneur. I don't care whether you're a one-man consulting firm or trying to build a company. If you're doing it from that seat, that corner seat, that is preparing you for what's next and optimizing your toolkit for what's next as we're going through this, as Schmachtenberger calls it, game A to game B. We're going through a game theoretical shift of winners and losers and incentives and rewards and all these and it's happened about every 180 to 120 years that we've gone through these real major structural shifts. And we're going through one right now. But if again, his work and many others, and just going out, Yusuf, to your original question, when you look through history, it has always been the entrepreneur that has survived and thrived and been essentially the solution. And that's always my ray of hope. So.
Got you. Wonderful. No, again, yeah. So I guess we are in or a hard next few years. So, yeah, hopefully, we'll be seeing better times here and then as we go along.
Yeah, and these are conversations I've had with my kids and anybody else that would care to listen to me, folks. I mean, we get a lot more sober in some of those conversations, but I really do have a view on the macro perspective. And again, I'm not just talking about the United States. I'm talking about the developed world, the Western world, Western Europe, of course, and the United States. And it's pretty sobering as to what we're going through and kind of how screwed up things really are. And this is why we go through these game theoretical shifts, because this is sort of the natural cycle that does take place. We get fat, we get lazy, the institutions get captured through interest pursuing, the greed for power and money, and then they collapse on themselves, and then we rebuild again. We go through a shift, and that's what we're going through.
I have a question. With this latest SEC ruling and no more sweetheart deals for certain VCs or certain investors, I should say, is that going to affect the investment landscape as well?
That I don't know, Bonnie. I don't know. I think the more structural expectations of transparency, that is a improvement in the system itself. So to the degree in which it's an improvement in the system, does that affect the investing process? I think it'll affect to the good. The more they're able to obfuscate or avoid transparency, then we're not learning our lessons, and we're just going to repeat the bad outcomes. It's just like deja vu all over again.
I know. Oh, I agree.
I know.
But still, are they going to miss those sweetheart deals? Time will tell. Anybody else have a question? I know we have a few more minutes left, so feel free to ask.
Told you we could wander far and wide on these calls.
Oh, I know. I should book you for 2 hours from now on. I think I'll do that. But I don't know what your time is like, too.
So actually, Bonnie, I do. So Joe, Bonnie, and Joseph, thanks. I feel like I'm being transported back. My dad took me to an AA meeting when I was a teenager to explain to me things. So I have to say, no, hi, I'm Ken. This is my first meeting, and I horribly resemble the article that you put out that I've read, Joe. I've read it. I've shrunk it down to 2 pages. I'm about to share to some people I know who do CEO coaching, saying this is the best article. I'm just going to tell, like I'm doing it poorly, for all the reasons stated in that article, because we're in scrappy mode and the rest. So I greatly appreciate you not only articulating it, but for some reason the way you articulated and the study, the two things together, because I am a contextual person, it just spiked it right into my brain. So I've already put on my calendar a monthly thing and saying bullets only, short, must get out. So this is fabulous value to me, and I wanted to state that. Thank you.
Yeah, no, that's why we're here. That's why we're here. Yeah, the era of the bullshitting entrepreneur, I think, is over. And again, I think we've had the lessons learned with Theranos and with Adam Newman's and the FTXs, and there's a whole myriad of, again, cautionary tales or horror stories that they all fall roughly into that same behavior pattern because they were a product of that system as well. And that worked, and there was a lot of enabling behavior that investors perpetuated and supported, like the Adam Newmans of the world. So there was, again, they were being rewarded for doing that. But I think that also, I do believe that's over. And that's a combination of, again, that era going through its collapsing cycle, but also this trajectory of changing the expectations of transparency, and then some of the other professional structures and the plumbing components that are getting put in place so that the private markets start looking more like the public markets. Those bullshitters, again, will get scared off. There'll still be bad actors, again, just like there are in the public markets. Audited financials doesn't guarantee anything, but it improves the overall outcome and quality of behavior and activities and information. So again, we're talking about the majority of the folks that get benefit from and are successful. So anyway, there was any more hands up, Bonnie? Or
I was going to say maybe, I mean, Adam Newman walked away a billionaire, and WeWork is about to totally.
It doesn't mean he's right.
Excuse me?
Doesn't mean he was right for what he
I
did.
know that. I spotted Adam Newman from the start because I met him when he was first starting WeWork, and nobody listened. I said, "This is a Ponzi scheme. How can you not see it?" They couldn't see it. I saw it immediately.
Look, most VCs don't know what they're doing. That's the undercurrent theme here is they literally aren't financial analysts. They really don't know what they're doing, but they're investing other people's money, chasing a story. Because it's not hard to spot the business models that just don't make sense at all, right? There are some Herculean changes in business models. One of them was Amazon. What he did was he created a new business model that can work, but it also requires an endless source of capital almost to make that business model work. This is what Elon Musk did, I think, is replicating in many ways, where he understands building balance sheet assets first matter. You know, Amazon sold books, but they built out their distribution centers. They were losing money on the books, but they were able to show enough momentum to attract continual capital because they went public. I think they were $300 million market cap when they went public. All right. And so he was still losing money, but he was able to articulate what the vision was, and the Wall Street folks understood it, or at least were willing to buy into it, if nothing else. But it absolutely worked. He built out balance sheet assets, and then he monetized those balance sheet assets. And it's brick and mortar. He wasn't just pure internet. He used the internet as a mechanism of in his business model, but he built out balance sheet assets that he then can turn on and monetize. And you're seeing that happen in other business models as well. The SaaS business model doesn't even allow for that, though. So anyway, that's a whole nother, that's maybe we should have that as a topic, as business models.
Okay. I'm happy to.
And analytics, because that's an interesting topic, and it makes what we're doing. Well, anyway, it'd be a fun topic.
That's another sequel. So we're looking forward.
Joe could cover another 2 hours on nonprofits.
Yes, I could. I was a philanthropy consultant for 20 years, and I've studied, and I continue to stay abreast of that world. And we could do 2 hours on nonprofits as well.
Yes, I'll send you some more dates, and we'll do it in a couple of months.
Okay.
So, we do post this on YouTube. So, do you mind if I send the attendees? I'll email them the information for your office hours on Fridays.
Oh yeah, absolutely. You could invite. Yeah, you bet, Bonnie. Of course.
Okay. Because I don't know if you want to spread it out to the world. I'm sorry.
Yusuf has his hand.
No, I think he just didn't put it.
I think it's been up the whole time.
I think he just didn't put it down from his question. Bonnie, before we close the room, I just have two sort of organizational notes. One is for everyone, September 7th, we have Glenn Argenbright from the founder of sorry about that, from Quake Capital joining us. So I also send out, second point is I send out an invite to friends of Joseph, as I like to call it. So if you want to get on that list with a direct Zoom link, just send me a note and I'll put you on there so that you don't miss the event on Eventbrite.
I am interested in that, but should I message on LinkedIn or?
Yeah, whatever.
what's the
LinkedIn.
best-
My email is josephkatz at gmail.com. It's easy enough. But this way, Eventbrite just changed their rules. They're going to start making it difficult for people like us to run events. So,
right. And I always post them in the newsletter. And as you know, I always send out the Zoom link like 2 hours before the event, just to make sure you all have it.
Yeah, that's very helpful, actually.
Yes, I always do that. Thank you so much. This was fantastic. Do you have any parting words of advice? Which could go on for another hour. I understand that.
It sounds really archaic, and I wish that the venture industry would actually adopt it. But there is a little known investment strategy that I think is still universally applicable, and that is, I believe it's phrased, buy low and sell high. So always remember that. Buy low and sell high, but you have to have the understanding of what low and high means.
Right.
What is low and what is high? But yes, that's my last piece of advice. Buy low, sell high.
Okay,
You
thank
know
you.
what low is, and you got to know what high is.
And I will send you all the link to Joe's office hours, which is 9 o'clock
Tomorrow.
Central.
Tomorrow morning, yeah. We have them every
Tomorrow
other Friday, but tomorrow is the next one. So.
And he hosts these every 2 weeks. Thank you, everybody. Thank you, Joe. This was fantastic.
Thank you.
As usual, and we'll see you all in 2 weeks when we have Glenn Archenberg.
Sounds good.
Everybody have a great day. And thank you.